Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso, and today we are continuing our series on Nelson Nash's Becoming Your Own Banker. I believe this is part 7, right?
Yeah, I believe part 7.
Absolutely. And so where we're on page 48, which is entitled Expanding the System to Accommodate All Income. Now, we've had clients reading this book for years, and inevitably when they get to this page, there's always questions, right? One of the first things that Nelson says on this page is, it always sounds a bit strange to people when I say premiums and income should match, right? And so what I think Nelson is really trying to do in these next page and a half is really trying to get us to use our imagination. Would you agree with that?
Agreed. I would say even when I first heard this, I was like, premiums equal income. I'm just starting out. I'm just trying to figure out what my premiums are going to be my first policy, let alone equaling income. But that is an advanced strategy, and it's not for everyone. However, we're gonna make it simple. We found a strategy or a process that we're going to share with you that will tell you when to start that second policy and for how much. So we will be talking about that later, and we created a video link, and we'll put that in the show notes as well.
Absolutely. And so Nelson is, he's a phenomenal teacher, and he always taught. If you've gotten this far in the book, you realize that he kind of taught in parables, right? And so he kind of taught us in lessons. And so the way that I would relay this to clients is I would say, okay, listen, what he's trying to do, he's trying to get us to use our imagination. And so I would give them a scenario and I'd say, okay, let's imagine that you are the owner of a bank and you just received your paycheck. Are you going to walk across the street and deposit that money at a competing bank, or are you going to turn around and deposit at your own bank?
I would deposit at my own bank.
Right? Exactly. And so that's what he's trying to get us to understand, is that idea, again, of ownership. Is if we own this banking system, is we want to maximize it and we want to utilize it to its fullest capability.
Agreed. And I think that story analogy had helped me as well of trying to understand this page as well.
On this page here, he's got a couple things, right? You and I both kind of understand Nelson and agree with probably a majority of what he says. Is there anything on this page that kind of jumps out at you where we may or may not agree with him?
Yeah, the whole right side, right? The whole right side of the page is a little, there's some good nuggets in there, and I think that those are for some people, but for me, I rarely would recommend that to a client.
I agree, and I think clients are kind of somewhat surprised when we typically discuss this, right? Is because sometimes everybody that kind of practices IBC tends to fall on a spectrum, and a lot of guys that follow Nelson are just diehards, and sometimes we don't agree with everything. So we want to make sure that clients understand that. And what he's talking about here on page 48 is he gives us a couple examples. Anthony, what's the first example that he talks about?
He's talking about trying to think like a banker.
Right.
Which is very difficult for us to really start thinking like a banker. For one, most of us don't like bankers.
Yeah.
Right. So we don't want to think like them, but we have to realize that what you have created is you have created your own banking system. And the way bankers view things versus how consumers view the same transaction are completely opposite.
What do you mean by that?
Like, for example, is a loan an asset or a liability?
Am I the bank or am I the lender or the lender?
Bingo.
Yeah.
Bingo. It depends how you are looking through it. Now, just a step back, we view assets and liabilities, define them similar to the way Robert Kiyosaki does. And that is, assets bring cash flow to you, liabilities take cash flow from you. Now, a lot of times we're thinking of a loan as a liability because it's taking money from us. That's because we're on the consumer piece, right? So a loan is a liability to us because we have to pay that cash flow to somebody else. But look at it from the bank's point of view. from a bank's point of view, is a loan an asset or a liability?
It's an asset.
Why?
Because they've got a monthly payment that's coming back to them, not only for the money that they loaned out, but also the interest on top of it.
Exactly. So a liability is different. I mean, I'm sorry, a loan might be a liability to consumer, but to a bank, it's an asset. But then let's dive a little deeper. Well, what about a deposit? You know, if you're a consumer, when you make a deposit into a bank, is that an asset or a liability?
It's an asset for me.
Right. It's an asset because you could take it out if you wanted.
Yeah.
Right. But what about on the bank's point of view?
The bank views it as a liability because I can come back and I can demand that money at any time. Mm-hmm. And in addition to that money, they also are going to owe me an interest rate on top of that, in which we've agreed upon prior to the deposit.
Exactly. So the moral of the story of this little scenario is, depending on what lens you are looking through the transaction, from a consumer and a bank are completely opposite. For a consumer, a deposit is an asset and a loan is a liability. But for bank, it's the exact opposite. Their assets are loans and their liabilities are deposits. So if we start looking at things through a banker's perspective, that's going to change things.
Right.
And it's going to change how we view deposits and how we view loans.
I agree 100%. Right. And the way that we look at loans and assets and those things, that's what Nelson is asking us to do. He's asking us to expand our system. And again, for me, it goes back to that imagination piece. If you kind of realize where he's stuck this, page and a half of information in his book, is he put it in here right after he's gone over the IBC sisters, right?
Mm-hmm.
And if you rewind even further back in the book, is what he talks about. He's on page 14. He says that IBC is really an exercise in imagination, reason, and logic. And so up until this point, he's laid out kind of the concept, and now he just kind of went through some of the logic that comes along with that. And now what he's doing is he's asking us to kind of use our imagination. And so page 45, what he did is he just went through and he said, okay, listen, here's what it looks like if the CD sisters and IBC sister finance one vehicle every 4 years. A very static example, right, for us to kind of wrap our head around and to understand. And then what he does is he says, okay, listen, on this page, he says, I want to, again, expand your imagination. And then what he's going to do is he's going to get into the equipment financing piece, where, again, he starts with where his nephew finances one truck every 4 years, just like the CD sisters, and he runs that example out. But what he does in addition to that is he goes through several more examples of what if we finance 2 trucks? What if we finance 3 trucks? And so I see this page very strategically placed in this book as saying, okay, listen, I hope you understand the concept. And now what I'm going to do is I'm going to kind of blow the roof off of this thing. And I want you to be able to kind of come with me and not be overwhelmed. You like that, didn't you?
Yeah.
Yeah.
That's good.
Yeah. So what are we going to do? Right. So this is what Nelson's done. What are we going to do in the example that we're going to provide? Right.
So one of the questions are, okay, we want to expand our banking system. Yep. Just as Cameron had said, we start off with, in this book, we started off with one policy to finance one thing, but you have other needs for finance. So the question is, what we need to do is we're going to need to potentially create additional policies.
Yep.
And the big question is, when do I do it? And what is a premium? What I had done before, and I think what a lot of people have done is, well, they would base it off their cash flow. When we got a raise or started making more money, okay, time to start a new policy. Or maybe we paid off some debt, or maybe we sold some property, or it is contingent on our cash flow increasing, which is very common, and that is a good way to do it.
Mm-hmm.
But I tell you what, for me, I like things to be a little more like structured. Like hitting a benchmark or something happening that I can say, okay, now it's time to start the new policy, and this is how much it's going to be. And we don't want it to be too difficult to explain that in the podcast, which is why we had created a separate video. It should be pretty short. I think it's under 20 minutes.
Oh, easy. Yeah.
But what it's going to do is just kind of show you one strategy to be able for you to use your policy or policies, and we'll show you how to use it. So you're going to have some benchmarks on when you're going to start that next policy, and we're going to have a good idea of what the premium is going to be on that as well.
Yeah. Anthony, correct me, did we touch on the kind of the self-insurance and the paying off the mortgage yet?
Not yet.
Okay, let's jump into that. So on page 48 on the right side, Nelson goes through kind of two examples. One of them is kind of self-insuring for collision coverage on your vehicle. And then the other example is taking over your mortgage. What are your thoughts on that?
Well, the first one on the insurance, I would say I've had kids on my auto insurance policies.
Okay.
And I'm not going to name names, but we've totaled 3 cars.
Wow.
One of them was me.
We've heard that. That's the pink TJ.
It wasn't pink. It was a yellow FJ. Cruiser,
that's right.
Big difference.
Yep.
But to me, on that collision, so far I have won with my auto insurance.
So let me jump in. What is it that you feel uncomfortable with? Is it?
It's so in essence, what Nelson's doing, what is suggesting, is instead of having like collision auto insurance, and that collision is only on your car.
Yep.
So if you run in, he's not saying be totally self-insured, but he's saying that there's that one option that if something happens to your car, that the insurance company will replace it. Now, if you're using bank financing, or you have a lease, they're going to require that you have that insurance. But if you have your auto paid off, that collision to protect, if you're responsible for and for an accident and the damage on your car, this is specifically what we're talking about. He's not talking about liability if you hurt somebody. For me, in my perspective, I don't want to take on that risk.
I agree, and when I think of it, I always think of certain scenarios. I think Nelson's coming from, when he wrote this book, right, he's coming from Birmingham, Alabama,
Mm-hmm.
right? I don't know how densely populated that was, back then, but I imagine Nelson kind of living probably not in the city, right? And so maybe there's not a whole lot of traffic or a whole lot of accidents. You and I, we live in Las Vegas, which is one of the most heavily trafficked cities in the United States, and so it's a totally different experience. So essentially what he's suggesting is taking over that risk instead of outsourcing that to a car company, insurance car company. And so personally, again, I kind of side with Anthony on this one. Is I don't feel comfortable doing that. And so when clients ask us about that, I straight up tell them, hey, that's not something I'm comfortable doing. I certainly can't recommend it for you.
And in essence, well, what Nelson's saying is that if you find out that insurance coverage, say, he used in the book like $750, or let's just say it's $2,000. Mm-hmm. Instead of paying the $2,000 the insurance company, you put $2,000 into a policy. So in essence, then that extra $2,000 is building up equity. And then if you have an accident, then you have that cash value that you could use to replace a car. And if you don't have an accident, then you have that equity. Here, I bet if we did the math, now that if you don't have kids on your policy, it probably makes sense. Yeah. Logically. But, for me, and this might be hard for you to understand because I'm so
much older. Yeah,
I don't want to insult myself,
Grandpa.
but I'm very analytical.
Oh, okay.
but I don't make all my decisions based on the math. Some of it will be of the ease or just not having that risk or burden. And this is one of those.
And another example, just to continue, is the other one that he talks about is saving up cash value inside a policy to pay off your mortgage, right? Again, that's something that we've looked at several different ways over the years. And so what are your thoughts on that, Anthony?
I say that it's never a bad idea to pay off your mortgage.
Agreed.
Rarely is it the best idea. And I think, like in any financial decision like this, there is not a cookie cutter that is best for everyone. But I would say for me, the way that I look at a mortgage is that I'm getting a 30-year fixed. Right now, interest rates are at an all-time low. If I can lock into that for 30 years, and who knows what the interest rates are by the time you're listening to this podcast, but let's say it's 4 or 5%. Typically, that interest is tax deductible. Again, it depends on some other situations that you have, but if you can itemize that 5% may really only be costing you 3 after the tax savings. And to me, it gets to be is what is the best use of your money? For me, I'm looking to, my goal is to get financial freedom. I'm looking to create passive income that's going to be more than my expenses. So if I had an extra 50 grand, great, I could put it down on the house. But is that going to lower my tax bill, Cameron?
Mm-mm.
Is that going to lower my payment?
Not unless you recast.
Exactly. So you make a large principal payment that it's not going to affect your monthly payment. And then what happens if an emergency or opportunity happens and I want that 50 grand back?
You've got to go qualify with the bank.
I got to ask somebody for permission.
For your own money back.
Exactly. So, and that's why I say for the most times, in most cases, I would not recommend being in a hurry to pay off your mortgage. On the flip side, I know there's some people that was a dream of theirs. That was a goal to own their house free and clear. You know what? If that's important to you and that's part of your goals, then you can use the infinite banking concept to expedite it.
Yep.
So we don't like to say, one way is the right way for everyone. It all depends. We need to look at the math, and we also need to figure out really what your goals are. We're not going to you shouldn't make all of your financial decisions solely based on math. You have anything to add on that, Cam? Probably not, because I think I hit everything so well.
Yeah, you rambled on and on. No, as actually what I was thinking was, as I read this page, one of the notes that I have written in my book is what I took away from it. And again, you can read this book and take away different stuff each time. But what I got Nelson kind of saying here is he was comparing an auto insurance company with a life insurance company and even a bank, right? When you're talking about the mortgage. And what he's saying is listen, what's the difference between those 3 types of companies? There really isn't a difference. They're all depositories, right? They're a place where you can put money on deposit. And so if you add a bank or you add a life insurance policy that's designed as a banking policy and you lay those 4 out in comparison, again, right? This is what we do every time I always come back to overfund and keep my money on deposit inside that policy so that I have it for opportunities. If we go with the bank, right, we just talked about that option is we're very limited on when and if we can get it back. And the same thing goes with the other 2. So that was kind of what I had written down in my notes as I read this book.
Like ideally, like in this example, if you had an extra 50 grand or whatever that is, ideally what we'd recommend is what if you bought a cash flowing asset? Whether it's a rental property or flipping land or whatever your or is, let's invest that money and use that cash flow to pay the mortgage. Because then as that mortgage is paid down, we lower your mortgage, but also you still have the asset, right?
Agreed 100%.
And we did create a video. One of the more common questions we get, and I particularly got it in the CPA firm, was, should I get a 15 or 30-year mortgage? And Cameron, what do most people think is the right answer?
Most people think a 15-year mortgage because that's what they're told by lenders and also mom and dad.
Yeah. So my philosophy is, if a 15 is better than a 30, then paying it in cash would be even better, right?
You would think.
Well, we did the math, and we have a video that we will put in. We're putting the show notes, and we walk through the different types of mortgages and the pros and cons in each. And I'm gonna give you the answer. If you were to compare,
you're gonna ruin it, huh?
No, this is gonna make it even more enticing.
Okay.
Or at least that is my goal.
Okay.
If you were to have pay for this house in cash, compare it to a 15-year mortgage, or compare it to a 30-year mortgage, at the end of the day, it's all the same.
What?
Right? The numbers are, but it's really how you look at those and what you do with them. And also, there's some intangibles. Which one's going to give you bigger tax deductions? Which one's going to give you more liquidity? Which one is going to have a lower monthly obligation?
Yeah.
And so we need to take all of those into account and your personal situation, and for you to make the best decision for you.
I strongly encourage you guys to go check out that link. It's a great video, and it is really surprising at the end of the day which one is best. And again, doesn't always come down to the numbers, right? Sometimes it's what I call life. There's those intangibles. One of the things that really plays into 15-year versus 30 outside the numbers is what options are available to us along the way, right? So,
just to add a little more sizzle.
Oh no!
Well, that video, out of all the videos we done, that one is my second favorite.
Okay. Awesome. All right. So we've covered a whole bunch, right? But let's bring it back to kind of expanding the system to accommodate all income. Is, again, a lot of times when clients are reading this, it's kind of a head scratcher. I don't know what Nelson's doing here, right? What he's trying to say. Again, Nelson talks in parables. And so what we've done is we've tried to kind of lay out a foundation or kind of a sequence of steps that somebody can take to get them to achieve this, right?
Mm-hmm.
Awesome. So check out the link. Make sure you look it up. It's a good video. We put some time into it, and hopefully we answer all your questions.
Well, I want to make a comment. Cameron, I teed you up a question to ask me.
Oh, my bad.
If the 15 versus 30-year mortgage is my second favorite video, well, what's my favorite video? I'm going to ask, and I'm going to answer it myself. And we did a video that focuses on creating cash flow from the policy, and we compare that to an investment portfolio, but then we also compare, well, what if you started to buy some assets with it?
That is a good one.
Thank you. That, and the reason why I like it, because that one had, I think it did a good job explaining why we use life insurance. It explained distribution rates and cash flow, and also the infinite ways that you can use that policy. But I will say, we haven't made that video public. It's only part of the Infinite Wealth course.
We got to pull it out, because those two videos right there will address two really big misconceptions that are out there.
Well, I haven't posted these on YouTube, and I don't know why. We need to figure out. I think they're so good. I think maybe I didn't want somebody else to copy it.
Yeah.
But I will put those in the show notes, because they're not on YouTube.
Okay, perfect. We'll hide them a little bit. We'll kind of make them available for you guys. But awesome, Anthony. What else do we got? Anything else you want to add here before?
You know
we wrap
what
up?
I do want to add. We're talking a lot about IBC and these policies, and if you've been listening, you may say, "Well, how do I get one of those?" Or how do they work? Well, what we would suggest in the show notes, there's going to be a link where you can get on a 15-minute phone call with Cameron or I, and we will answer those questions and really go through to see if IBC is for you. And if it is, we will show you the next steps on how you can become your own banker.
Awesome. Hope you guys enjoy it. Take care.
Make it an awesome day.
Have a better day.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.